Hey folks, it's Dave Burrows. It's Tuesday afternoon. It's 4 o'clock. Must be time for our Barometer Readings webcast. I want to thank everybody for joining today. This will be the last webcast that we'll do until the beginning of the new year. Things are certainly winding down. Markets are thin. Relatively small volumes are moving prices around. I think there's a lot of position squaring going on at the end of the year. Some tax selling for sure, because it's been a year where there have been some big winners and certainly some losers. Lots of dispersion in the market, meaning some things working and some things not. I think I've got a slide in here today that shows something like 34% of companies have beaten the S&P so far in the year. So you kind of had to be in the right spots. And certainly after a very strong month of November, there was likely to be some rebalancing, which we've talked about over the last couple of weeks. So why don't we hop right in, and we're going to do a quick review. Not tons changing. As we've talked about, we're in this bull market that started in 2013, and the market's just been sort of trucking along since we made the high in January of this year. S&P's slightly positive on the month of December, although it's a little bit misleading. Now, I want to put this up again because everyone worries about next year. 2023 and 24 have turned out to be pretty good years. And so the question is, do we have a red one coming at us? I just wanted to highlight that when you're in a structural bull market like we have been in since 2013 or like 1981 through 2000, the good years come in bunches. So if we go back in the early 80s, you went to 1990 before you had a negative year. And then you went 91, 92, 93, 94, 95, 96, 97, 98, 99, tough year 2000. But that was the rollover into secular bear market. And so, when you look at it, we had this minus 18 year in 2022. There was also, a tough finish to the year in 18. But we're really, just sort of 2 years into this new cyclical bull market. And we've highlighted that when you got to 2 years, which was October, it tended to be the bull market had an average length of just over 5 years. And obviously averages, are made up of a lot of things, and you can certainly have, strange events. But the net of it is 2 good years tends to mean a relatively good year in the third year, and it doesn't have to be in a straight line, but sort of seasonally we're into a decent period. If we take the near-term picture, we've been marching higher with a series of pullbacks to moving averages. We recently had a pullback in the fall to the 50-day moving average, and over the last couple of weeks, this market's been consolidating. But as I mentioned, it's a little bit misleading. If you were to look at the Dow, it's had basically 10 days down in a row and has corrected back to the 50-day moving average. And this is not unlike if you looked at the equally weighted S&P, or if you looked at the value index, which had 10 days down in a row. That's pretty rare. It's rare to have that happen. And as we talked about, this year, a relatively small number of companies beat the index. But, when you do have a bunch of days down in a row, while the market is trading above the long-term moving average, which clearly, we're trading above the 50, but this is the 200-day moving average, meaning when we're in a bull market, 8 days down in a row tends to be more like a consolidation before going higher. So 1 month out, you've got 5 out of 6 periods higher, 2 months out, all periods higher, 3 months out, all periods higher, an average of 5 to 6%. So while we don't like to see, things pulling back, it has to happen. We can't go straight higher. And certainly the market gapped higher right after the election, and that maybe stretched things a little bit. But we'll look at it from sector to sector. But I want to keep in mind that it tends to be that December, the first half, is sort of sloppy. And, it's the same in an election year. And it tends to be that what they call the Santa Claus rally tends to come in the back half of the month. So we'll see. It's the 17th today. Market was down a little. The S&P down about 0.5%, NASDAQ down about 0.5%, the Russell down about 1%. But certainly, people have been used to the market going straight higher, and I've had a few calls saying, should we be worried? At this point, we don't think that that's the case, but certainly we'll move on. We talked last month about the value line geometric index. And I want to remind you what this is. This is 2,900 US public companies, unweighted. In other words, they're all counted the same. And I think it was really important that we got out through a 2-year period of congestion in the month of November. And yeah, we pulled back a little bit, about half of what we gained last month. But really, that's not anything really to worry about. It would be very rare. We just go straight higher. So not too concerned. In the Canadian market, reminding you that the makeup is very similar to our portfolios, bigger weights in the more inflationary sectors. It pulled back about a third of what it gained in the month of November. And so again, it's not going straight higher either. But when we look around the world, Canada, Europe, Japan, China, all US, London, which is an important leading market in Europe, all have positive breadth indicators. Global breadth was down a little over the week, 1.4%. It takes a 6% reversal in the percent of stocks in uptrends for this to go from green to pink. And so, clearly sort of the most important developed markets are showing some strength. In the world of fixed income, 10-year treasury yields have been working their way higher since 2020. And they've had a series of pullbacks and then higher highs. And recently this pullback came down to about 4%. We're back at about 4.42%. If you look at the 30-year, it's a little bit higher. When we look at what happened after the Fed cut rates in September, it's the first time in 40 years where the yield on a 10-year treasury bond went up while they cut rates. That's bond investors saying there's now greater risk of long-term inflation. And so we want to get compensated. We want to get paid a higher yield to commit our money for 10 years, or more importantly, for 30 years. So that's something that we keep in mind. Now, we've highlighted that what works during falling interest rates is very different than what works during rising rates. If you consider that during a period of disinflation, the risk was falling prices, great to hedge with fixed income. On the other hand, if the greater risk is rising prices, you need things that are helped by inflation. Things that were helped by falling interest rates may not be helped by rising interest rates. And a great example was a chart I was looking at this week that looked at home prices adjusted for inflation. And we've said a few times over the last couple of years, real estate is really helped by falling cost of money. And if you look at the last time rates bottomed in the early 1950s and started moving higher, from 1950 really to 1990, there was a 0% increase in the price of the average home versus inflation. And certainly from 1950, to the mid 1970s, you lost money versus inflation. So I understand why people love real estate. It's been very good to them over the last number of years, but that is unlikely to repeat if we think that rates stay sticky higher longer. So the TLT, which started its decline in 2020, is having a really hard time getting off the carpet. This is the ETF for long-term treasury bonds. It continues to be below all the long-term moving averages, which probably means, that things that get hurt by a high cost of capital continue to get hurt. We've hedged using equities because equities have the ability, if you're the right ones, to put up price tomorrow if your costs go up today. And we've hedged with things like some commodities, and we've hedged with assets that have a tendency, to do better, like dividend growth stocks in a more inflationary environment. And certainly stocks versus bonds continue to outperform, and this continues to be our preferred mix. On commodities, it's a little bit deceiving. Certainly commodities had a terrible bear market as a basket up until 2020. They had a great first leg higher. into the global tightening cycle. They consolidated. They really didn't pull back very much. They started marching higher again. The one thing I will highlight is that the strongest commodities recently have been more agricultural commodities. We've all read about the price of cocoa and the price of coffee going higher, but the basket in general is working its way higher. And another indication of inflation, and people trying to hedge against it, is what's happening with Bitcoin versus the US dollar. And we talked a little bit about this, and a lot of people don't have exposure here. We have it in our macro fund. It's a 10% weight. But certainly it's been marching higher after a bear market that went on from 2021 to 2024. But look at these moves. It was a very significant move leading up to the top in 2014, about 1,700% in 2017-18, about 400% in 2021. And it's higher. It's up about 58% since we broke out of this range. My guess is probably it has room to move further. Now, just quickly speaking about currencies, I have to mention it because I'm sitting here in Toronto. Canadian dollar had a tough week. Certainly, the market doesn't like political turmoil. The Canadian dollar has been signaling that there is difficulty in the Canadian economy for some time. And certainly, global investors don't love the spending, I don't think, that the Liberal government's been doing. I thought this was a really interesting chart. Of course, we know what happened this week with our Minister of Finance. And in all the political turmoil around it, this is global investors voting with their feet. But I thought this was just a shocking number. The annual public sector growth by Prime Minister, going back to Pierre Trudeau. And it's hard not to get upset when you look at this number. 4.5% a year between 2021 and 23. Clearly this is why we had a $61 billion deficit, and clearly why they didn't want to bring the financial update in a timely way. So moving on, just from a sector perspective, certainly we're continuing to see strength in financials. This was the month of November. We've given up, I don't know, about 40% of what was gained in the month of November. Again, as I mentioned, we don't go straight higher. The financials, so this is a little bit blurry. Still 95% of financial services companies in uptrends. That's very healthy. We're above all the long-term moving averages. Our key holdings, our number 2 holding in the firm is CIBC, trading at new relative highs today versus the market, has been on an upward march over the course of the year. The largest firm holding is Fairfax Financial. It's trading better than 85% of companies in the S&P, made a new absolute and relative high in the last week, but a new relative high today. And JP Morgan, which is backed off just a little, is trading above important moving averages and is outperforming large cap banks in the US. So very happy with these holdings, all 3 in the top 10 holdings in the firm. In the industrials camp, we've seen a little pullback above the moving averages. Not too concerned about that. In the basic materials, again, continue to be in an uptrend, although, we have seen the metals and miners pull back on the back of some weak steel prices. Some of the guidance given by Nucor this week and Steel Dynamics were weaker. But again, we're trading above long-term moving averages. And, you got to pick your spots. Our big weight in materials is in gold. Agnico Eagle is a top 10 position, trading better than 84% of companies in the S&P. We like the fact they've been able to grow their dividend 26% a year over the last 5 years. It's got a 1.9% dividend. They're generating lots of cash and certainly a beneficiary of higher gold prices. And it's not all gold companies that have been able to operate efficiently. Agnico is one of the rare ones. In the world of energy, again, energy's pulled back into longer term support. We talked a little bit about seasonality here. Imperial, which is our largest weight, has pulled back a little as well over the course of the month. We never like to see them pull back, but again, you got to take the lens back and realize that they don't ever go straight higher. And we are now at the seasonally weakest time of the year for oil. And it tends to be that from December through January, February, March, April, May, and June, it's a good place to be. So pretty comfortable with our holdings there, all of them paying us great dividends, all of them giving us great dividend growth. So sector by sector, there are some winners and there are some losers. We've talked about consumer discretionary over the last couple of weeks. This is the ETF that is the market cap weighted consumer discretionary ETF. Two big holdings in here would be Tesla and Amazon. They'd be the biggest and biggest by a lot. They've just had a dynamite week. You can see your 2 weeks, 3 weeks, 4 weeks. You've seen the relative strength line moving higher. The consumer discretionary group is making new relative highs versus the S&P, so that's quite favorable. And Amazon really has lifted off out of this base, is making new relative highs as well. So this is not our biggest position now, but we've built it through portfolios over the last month or so. It really appears like they've got a dominant position coming into the holiday season. They've continued to cut their costs. They've continued to get more efficient. And with AI, they have been significantly cutting their cost of fulfillment. So this could be one of the companies that actually can show, real benefit from using AI outside of the chip companies, of course, that are selling them. The other two positions that we have in consumer discretionary, Costco trading very close to the highs at a relative high versus the market, and Loblaws, which has just been a champ over the last 6 weeks, rallying from 173 to 193 just on a rope. So again, it's really been about picking our spots. I'd love to say we own Tesla. We don't. We did debate it internally. I didn't win the debate, but very happy with what's happening with these core holdings. So Amazon, of course, has been a very good ad. In communications, it continues to be sort of large cap, AI related that's working within communications. Meta has been our big position, and it traded over the past week in a new relative high versus the market, and performing well. So as we come to the end of the year, it's an interesting year. We get to a point where people who have winning positions don't tend to want to sell. So that's why in the last 2 weeks, some of the year leaders up to this point do well, because people want to hold over gains to the new year. And we have seen a resurgence in some of these large cap stocks. In technology, it has been a mixed bag. We've talked about how relative strength for the group itself, this is large cap tech leaders, all the way from Apple on down. There have been winners and losers. The cybersecurity companies are winning, and some of the software companies are winning. They're having a nice pickup in relative strength. And on the other hand, we've talked about semiconductors, which, have been great for years on a relative basis, have been really struggling here, now trading sort of below all the key long-term moving averages. So this is something to watch. We don't have a big weight here. We certainly have, our position in NVIDIA, but to be honest, that's really on the bubble. I know that they've just come out with a small-sized AI chip that will go into robots, which they think is going to be big product for at $249 a piece. We'll see, but certainly, this is a group that we're watching. In the technology sector, only about 64% of stocks are in uptrends, and that's been weakening, which is why we do have a relatively lightweight in technology. But of course, our big weight is Apple, and it's just been dynamite over the last 3 months, really lifting from 219 to 253 and coming into the end of the year at a new high and a new relative high. So there are things that are working. As we sit going through the month of December, the very large caps have outperformed. Some of the small cap stocks have retrenched after a big month in November. But what is clear is that the defensive sectors, the ones that would do well in the event of a recession, are not picking up the baton. So this is an interesting fact when I look at the consumer staples, weak relative strength. When we look at healthcare, horrible relative strength. When we look at REITs, hurt by rising rates, horrible relative strength. And we look at the low volatility sector. So these would be sort of consumer staples, things that are not economically sensitive, very weak relative performance. So still by nature, with industrials and financials leading, with strong performance in some of the industrial mid caps. Continue to think that the economy is probably in a decent spot. When we look at the sector breadth, it was down a little over the week, about 3%. At the far right, sectors that have a high percent of stocks in uptrends, a lot of financials, banks, regional banks, and insurance companies and Wall Street. At the far left, we have some weakness in healthcare and consumer, but we have seen some pullback in some materials like steel, which is something certainly to keep an eye on. Our sector weights, I think, probably continue to be in line. Financials close to 30% of firm exposure. We really like the stable cash flows. We like the fact that they benefit with higher long-term rates and lower short-term rates because they can capture the difference in their net interest margins. The fact that the markets continue to be pretty stable mean that the capital markets banks are likely to continue to do well in pricing and insurance. After all of the catastrophes this year, look like they're going to stay pretty hard for the upcoming year. Given some of the new Republican policies and tariffs being proposed, we think industrial companies in the US are likely to do well as multinationals build additional facilities in the US. We think the energy sector is likely to stay strong, especially on the back of some of the data centers that are going to need additional power, and natural gas is going to wind up fueling some of that stuff. And we continue to be very, very light in healthcare and utilities and real estate. And frankly, we're still a little cautious on the consumer because interest rates, can have an impact there. When we look at credit risk, there is no sign that bond investors are concerned about credit. When you look at the excess return that a corporate bond investor is requiring in order to make an investment in a corporate bond versus a government bond, it continues to narrow. If there's concern about credit risk, you see spreads widen. So as we sit, no real concern here when we look at the risk of inflation. When we look at volatility, we're not absolutely at the lows, but we're in the lower bound area of where we tend to be during the best equity bull markets. So we come into the year, as we come out of the year, as we sort of came in, we are in a cyclical bull market. We think investors are looking toward the next economic cycle. We've started a period of liquidity with central banks cutting rates. The risk remains that inflation is resurgent. And so we are focused on hedging the portfolios with inflation hedges, not hedges that you would use if you were going to have falling prices or disinflation. And we keep in mind that when the market's been up strongly over the course of the year, it tends to be that December winds up being pretty strong, and now we're headed into the back half of the year. Now, if the data gets weaker, we'll get more defensive. We've shown that we'll do that in the past. But we don't expect major changes in the way the market's behaving as we enter the new year. But we'll go through all the numbers. We'll try and bring some fresh charts at the beginning of January. And we'll continue to try and make sure that we're in the road of the key things that are driving returns in the market. We're pretty happy with how the year's gone over the course of the last 12 months. And we'll try and keep it going forward. So with that, let's see if there's any questions. So the question here, we talk generically about tightening stop loss orders when the market tends to start to fail, in particular stocks and broader markets. Can you discuss in some detail about actions taken of late to tighten stops on current positions, in particular those names not demonstrating recent alpha performance versus the market? Sure. So, there's a delicate balance between putting a stop loss in that's really close to current market price and putting it in too close, because within the natural market behavior, stocks pull back. So what we try to do is we look at the long-term performance of a stock and the trend that it's been in. Should be making higher highs and higher lows if it's constructive. Now I use a point and figure price chart in order to do that. Point and figure price charts highlight very clearly and quantitatively higher highs and higher lows and when the behavior changes. So as I was highlighting, a bunch of stuff is pulled back above moving averages. A simple way to do it would be to use a moving average, although everybody on earth looks at the same thing, so I don't think that's the best way to do it. But when we're trading above all the long-term moving averages on positions, I want to stay in them. If they start to fail, then it's time to go. Certain sectors, the stocks are more volatile by nature. And so to put a stop loss 5 or 6% off the high on every position would mean you're naturally going to get stopped out very often on stocks that are more volatile. Some stocks are naturally less volatile. So when they become more volatile, that's where the stop should sit. So every company has a different personality. We try and recognize that. But we do use a quantitative process and point and figure charts to try and set the stops. And, when things get more sloppy, and you can see still the long-term indicators on the US markets and most global markets, not all, have been quite favorable. We don't get too fussed about things pulling back for a week or so. It's not about getting out of a position in the first week. It's making sure that if things are going wrong in month 2, 3, or 4, you stepped aside. I've got a question here. Question on lumber and forestry stocks. To be honest, I have not spent a lot of time looking at the lumber and forestry stocks because they have been weak over the last little bit. But if they break out and start to lift, they'll show up in our models, and we'll take a closer look. I would be concerned about tariffs on the Canadian lumber. I have a question on, do we short stocks, and if so, what are the triggers to short? So we do, in some of our mandates, short stocks, try and take advantage of falling prices. What we're looking for there, ideally, we want to do it when market breadth is weakening. So you don't have help from the market. You've got to help as a short. We look for sectors that are showing deteriorating breadth within a weak market. And then we look for a weak stock that's behaving weaker than the rest and with weak fundamentals. So we don't spend a lot of time trying to short stocks in a bull market. It's a bit like picking up dimes in front of a bulldozer. And so we have not been shorting very much. But we do have a short in the bond market and have had to short in the bond market for some time. We have a short in a couple of sectors. We do have a small short in the semiconductor index, but that's more broadly focused. We're pretty selective, but we do tend to short when things get sloppy and look like they're going to stay sloppy, and that's just not the case right now. I think that's about it. There's a question here on copper. This is one of the groups that does pull back a lot more than others. I would say, they are in a precarious spot. I think that some of them are being impacted by tax loss selling here at the end of the year. Uranium, we are less worried about. But to be clear, depending on the name, some are acting better than others. 4N mining is behaving quite well. Tech is in a precarious spot. So we're going to have to see how they finish up. But here we are headed into some better seasonality. So we'll see. With that, we'll be back in the new year. If you've got questions in the meantime, or you'd love to talk about something in particular, don't hesitate to reach out. We're trying to work through doing reviews with clients right now, and if we haven't talked to you recently and you'd like to have a conversation, please let us know. We've been really happy to Tiffany Harding joining us a couple of weeks ago. She's a great addition to the team. And I guess one last thing, we've been really pleased. We had a valuation done on the music fund, and after paying just over 9% on the year, it looks like it's going to have about an 11% lift in the valuation for the year, giving us a total return of about 20%. So pretty happy about that. If you've ever got a question about that, we're certainly happy to talk about it. Thanks very much, folks, and I hope everybody has just a wonderful holiday with their families. Be healthy, and we'll see you in the new year.